When it comes to money, most people dream of investing like the pros. But markets are unpredictable, emotions run high, and many investors end up losing more than they gain. Is there a better way? Benjamin Graham, known as the father of value investing, believed there was. His classic book, The Intelligent Investor, first published in 1949, is still considered one of the greatest guides to investing ever written. Even Warren Buffett, one of the richest investors in history, has called it by far the best book on investing ever written. Graham's approach is simple but profound. Investing is not about chasing trends or timing the market. It's about discipline, patience, and focusing on long-term value rather than short-term excitement. Welcome to 10-Minute Books, the channel where we break down the world's most powerful books into practical lessons you can absorb in just 10 minutes. Today, we're diving into The Intelligent Investor by Benjamin Graham, a timeless guide to investing wisely, protecting yourself from mistakes, and building lasting wealth. The core idea: be an investor, not a speculator. Graham draws a clear line between investors and speculators. Investors analyze companies carefully, buy with a margin of safety, and hold for the long term. Speculators, on the other hand, chase price swings, try to time the market, and often act on emotions. Graham warns that speculation is like gambling. It can bring short-term excitement, but over time, it destroys wealth. True investors avoid speculation and focus instead on steady, rational decisions. Mr. Market, the metaphor that changed investing. One of Graham's most famous concepts is Mr. Market. Imagine that you own a business with a partner named Mr. Market. Every day, Mr. Market. Market offers to buy your share or sell you his, but his moods swing wildly. Some days he's optimistic and offers a high price. Other days he's pessimistic and offers a low one. The intelligent investor doesn't let Mr. Market's moods control them. They don't sell just because he's pessimistic, and they don't buy just because he's optimistic. Instead, they evaluate the actual value of the business and act only when the price is favorable. Mr. Market is there to serve you, not to guide you. The wise investor sees volatility not as a threat, but as an opportunity buying when fear drives prices down, and staying calm when greed inflates them. The margin of safety. Perhaps Graham's most important principle is the margin of safety. This means always buying investments at a price significantly below their intrinsic value. Just as engineers build bridges to hold more than the maximum expected weight, investors should build a margin of safety into every decision. This margin protects you from errors, uncertainty, and unforeseen events. If you overpay for an asset, even small mistakes can wipe you out. But if you buy with a cushion of safety, you reduce your risk and increase your chances of success. Think of it as a financial seatbelt. You may never need it, but when things go wrong, it can save you from disaster. Defensive versus enterprising investors. Graham distinguishes between two types of intelligent investors: defensive and enterprising. The defensive investor values safety and simplicity. They don't want to spend hours analyzing stocks. For them, Graham recommends a balanced portfolio of high-quality bonds and stocks, regularly rebalanced and avoiding speculation altogether. Defensive investing is not glamorous, but it protects wealth and provides steady growth over time. The enterprising investor, on the other hand, is willing to put in more work. They carefully research undervalued companies, look for hidden opportunities, and actively manage their portfolio with discipline. For this path, Graham stresses the importance of patience and skepticism, ignoring market fads and waiting for the right opportunities. Both paths are valid. The intelligent investor isn't defined by aggressiveness, but by consistency, whether defensive or enterprising. The key is sticking to principles rather than chasing hype. Stocks versus bonds. Graham explains that both stocks and bonds have a place in a portfolio. Bonds provide stability and income, while stocks offer growth potential. The intelligent investor balances the two, often recommending a 50-50 split as a starting point, adjusting based on market conditions and personal risk tolerance. The danger of emotions. One of the biggest enemies of investors is themselves. Greed makes people buy at the top, and fear makes them sell at the bottom. Graham emphasizes that discipline and emotional control are essential. The intelligent investor doesn't react to market noise. They stay patient, stick to their principles, and trust the long-term process. Analyzing stocks, value versus price. Graham stresses the difference between value and price. Price is what you pay, value is what you get. Intelligent investors don't just chase low prices. They look for companies with strong fundamentals, consistent earnings, good management, and financial stability. The goal is to buy quality companies at fair or discounted prices, not to gamble on risky, flashy stocks. Dollar cost averaging. To avoid the temptation of timing the market, Graham recommends dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of market conditions. Over time, this smooths out market volatility and reduces emotional decision-making. The role of index funds. Although Graham wrote long before index funds became popular, his advice foreshadowed them. For defensive investors, he recommended buying a diversified set of stocks and holding them. Today, index funds accomplish exactly that, making them one of the best tools for average investors. Case studies and examples. Throughout the book, Graham provides examples of companies that looked good on the surface, but were dangerous in reality. He warns against following the crowd, chasing hot stocks, or believing hype. Instead, he encourages a slow, steady, evidence-based approach. Lessons for modern investors. Though written decades ago, Graham's principles are more relevant than ever. In today's world of meme stocks, crypto hype, and speculative bubbles, the need for discipline, value investing, and a margin of safety is stronger than ever. His wisdom reminds us that while technology evolves, human psychology, fear, greed, and impatience remains the same. Criticism and balance. Some critics argue that Graham's methods are too conservative for modern markets, where technology and innovation move faster. Others say that opportunities for value investing are harder to find today. But even critics acknowledge that Graham's focus on discipline, safety, and long-term thinking remains foundational. The big takeaway. The intelligent investor teaches us that success in investing doesn't come from luck, timing, or chasing the hottest trend. It comes from discipline, patience, and focusing on value. By remembering Mr. Patience, timing, market, insisting on a margin of safety, and choosing whether to be a defensive or enterprising investor, anyone can invest more wisely. The question is, are you letting Mr. Market's mood swings control you, or are you sticking to principles and focusing on value? That was The Intelligent Investor by Benjamin Graham, broken down in under 15 minutes. Which idea resonates most with you, the margin of safety, Mr. Market, or the defensive versus enterprising investor? Share your thoughts in the comments below. And if you enjoyed this summary, make sure to hit that like button, subscribe to 10-Minute Books, and ring the bell so you never miss our weekly breakdowns of life-changing books. Thanks for watching, and remember, the stock market is there to serve you, not to instruct you.